Portfolio income can play a vital role in seeking to preserve and grow wealth. Such income, and especially reinvested income, have been the principal drivers of diversified portfolio returns over time. What's more, it has often helped mitigate volatility within portfolios, especially during times of market turbulence. Unfortunately, though, portfolio income has become much harder to earn over the last few years. With interest rates near record lows, neither bonds nor cash offer the income they once did. And recently, the challenge for investors has become greater still. In last year's edition of Outlook, we warned of the dangers of negative real interest rates. This phenomenon is where central banks deliberately keep interest rates below the rate of inflation. Low interest rates obviously help governments and those private borrowers who have large debts. For a start, low rates make it easier to pay interest on what they borrow. Higher inflation, meanwhile, eats away at the real value of their debts, making repayment easier when the time comes. This process was key to reducing the giant debt loads that governments built up in World War II. Over the next few decades, the U.S. managed to lower its burden substantially via this policy. While good for indebted governments and companies, negative real rates are very bad for their creditors. In the post-war era, investors who owned government debt and cash saw their holdings do badly. From 1945 to 1981, an allocation to U.S. 10-year treasuries would have lost more than half its purchasing power. Likewise, interest-bearing cash would have suffered a loss purchasing power of nearly 1/5 over almost the same period. We liken this phenomenon to a cash thief whose activities eroded the wealth of many unprepared investors. So what is the risk to cash and fixed income allocations today? Since our original warning, the threat to cash and bonds has only gotten worse. As the world economy has reopened after COVID lockdowns, inflation has picked up. Despite this, global central banks are largely keeping interest rates very low. As a result, the 10-year U.S. Treasury yield after inflation has dived to its lowest level since the last era when the cash thief was on the loose. Over the last 12 months, global fixed income and cash have both suffered real losses. Nevertheless, we see many investors with outsized holdings of cash and too many low or negative yielding bonds. The longer this continues, the greater a risk that such investors will see their level of wealth eroded. With the cash thieves still at large, we call for investors to consider important changes in portfolio construction. This means seeking more income away from investment-grade bonds and cash. Even after their powerful rally since March 2020, global equities offer a higher dividend than global fixed income. One possibility we see is within this asset class is equities with a consistent record of growing their dividend payments over time. These include some equities from sectors such as healthcare and semiconductors. Likewise, we believe there are select areas of fixed income where yields are somewhat higher, including emerging markets debt and preferred securities for those willing to increase their level of risk. And for qualified investors, we also see income potential in certain capital market strategies and private market strategies. Both history and recent experience have shown how painful the cash thief's exploits can be for investors. However, we also know that it doesn't have to be that way. Instead of holding too many cash and low-yielding bonds, you should consider building a portfolio that aims to beat the cash thief. Put your excess cash to work and reallocate to the income-seeking strategies that we identify. Find out how in our Outlook 22 publication.